And this is the greatest time of all. It's reporting season. People like Paul and I get excited at reporting season. It's week 3, and we're going to look at 4 really big guns, aren't we, Paul?
We are. Let's start with the biggest of them all, Peter, BHP. It reporting underlying EBITDA of $10.5 billion US for the first half. That was actually down 3% on the previous corresponding half, largely due to some unplanned outages. For example, the derailment in the Pilbara certainly cost it some hundreds of $millions. On a dividend sense, continues its cash return to shareholders, a dividend of US 55 cents. Important to note there, that's 18 cents above their minimum payout. They have a minimum payout of 50%, so they're actually supplementing that mainly because they're doing so well and they've got lots of cash at the moment.
The problem of too much money.
Yeah, and it follows a special dividend of US $1.02. From a highlight point of view, they maintained their full-year cost guidance. This is important.
Yeah.
They expect stronger volumes in the second half, so the second half profit should be up on the first half. Look, the balance sheet's really strong. Net debt's under their target, their minimum of sort of $10 billion. They're generating lots of cash, and CapEx they've got down to less than $8 billion they expect for the next couple of years. The negative for me, Peter, was that there weren't any productivity gains. BHP's big about, in the last couple of years, about being able to mine more efficiently and get more productive. Costs actually went the other way in this half, and productivity actually deteriorated. Now, they say they're going to get back in the second half, but I think it's becoming stronger for the major miners. Look, I think this is about as close as it gets to the
perfection.
Top. Well, perfection for BHP. Look, commodity prices are still supportive. Clearly, BHP and Rio have benefited the last few weeks from the disruption with Vale in Brazil. And if commodity prices stay supportive, those shares are going to keep on going up. But look, I think BHP is probably almost in profit territory for me at the moment.
Okay, mate.
Take it territory, I should say.
Let's go to the next one, Woolworths.
Yeah, look, it actually disappointed a little bit, Peter. It's maybe because it's been priced, the market's been pretty supportive of Woolworths. So EBIT was only up 1% to $1,445 million, and NPAT up 1.9%. The dividend just up 2 cents to 45 cents per share. Now, the highlight, I guess, was the Australian food. That's the supermarket division. Their EBIT, their margin improved and sales improved. They actually returned to winning the supermarket wars, beating Coles in the fourth quarter.
It's a big win.
Yeah, comparable sales growth of 2.7% versus 1.5%. So that was a positive. And the other positive for shareholders is they confirmed that following the sale of their petrol business, another $1.7 billion would be coming back to shareholders. That will be an off-market buyback. That'll be great for low-rate taxpayers such as self-managed super funds. Hopefully they'll get that done before the 30th of June. It just needs one more confirmation from the FIRB in terms of the sale. Negatives, probably the surprise for the market, what had been a very successful Endeavour Drinks division, which of course is their Dan Murphy's and other businesses. EBIT was down 6.9% as sales slowed and some cost pressure started to bite. Big W, problem department store, that's still in the red, but sales are improving.
I've got to say, I've been seeing the Big W store. It's surprised me how good some of the stuff is.
But still losing money, and they had a fairly cautious forward-looking statement, talked about some cost headwinds, particularly for through some of the EBA arrangements with their staff. So, look, bottom line, a bit of a miss. I think the capital return will provide support. So for me, Woolworths has come off a little bit. It's probably now in hold territory.
Yeah, and it's also got a lot of competition. Like Aldi's growing all the time. There's even new ones coming to the market. Yep, Paul. Let's go to Coles.
Coles was also a miss. EBIT down 5.8% to $733 million, mainly due to the challenges with its convenience business. Supermarket business was actually flat. No dividend, but it did reconfirm guidance of a target payout ratio of 80 to 90% for its first dividend in September. Look, sales growth of 3% for supermarkets, that wasn't too bad, but as we talked previously, Woolworths has overtaken it in the second quarter of that period.
Yep.
And they've also announced a new agreement with Viva Energy. Now, that's to do with the supply of petrol at their convenience stores. That'll take sort of Coles almost out of the loop, take away the vulnerability to petrol prices for Coles. That should be a positive and see the convenience stores back on a more even playing field. Negatives, look, unlike Woolworths, their margin in supermarkets declined. That's due to higher costs. So Woolworths is still a lot more efficient. And they talked about cost headwinds in most of their divisions. So, look, bottom line, the market sold off. The Coles shares lost more than 9% over the 2 days following the result. I think there's a bit of value starting to emerge in the low $11. I always said that Coles, I didn't see it as a classic demerger story. It was too priced up front. Some of the analysts, I thought it was a sell at 13. I said it was a buy at 11. I'm starting to think Coles looks like reasonable value at $11. It's not going to shoot the lights up by any means, but you know it's largely a supermarket business, and I think despite the pressures from the others, you know, it can basically produce those earnings and deliver a reasonably high dividend. And, I think as an income stock, $11 is starting to look attractive.
Yeah, okay. Let's go to Westfarmers now, Paul.
Well, Westfarmers surprised on the upside. So we had negatives for both Woolworths and Coles. Westfarmers actually did better than the market expected. NPAT up 10.4% to $1,080 million. That's from continuing operations. That's largely due to the phenomenal success of Bunnings.
What a great story.
I think the market was a little bit surprised at the Bunnings result because we know that allegedly the home market's challenged and consumer sentiment have waned a little bit, so maybe that would impact on people wanting to spend on hardware and other things they buy at Bunnings. But look, EBIT for the Bunnings Australia division up 7.9%, now 58% of the group, and comparable store sales growth of 4%. That's not bad when you look at some of the retail sales figures. So Bunnings, you know, just continues to power ahead. Also, Officeworks did really well, EBIT up 11%. The negatives, well, Kmart Group, we know that Kmart has stalled a little bit after some great years. Target still a drag, but at least sales were positive in Target for the first time. They also warned about the medium-term weakness for some earnings in their chemicals business in the second half. So, look, Westfarmers is that conglomerate. The big news for shareholders was the dividend. While it's $1, and that's actually down from $1.03 in the corresponding half of last year, it now only includes 5 months' worth of Coles business, so that's one of the reasons it's down. But they announced a special dividend of $1 per share, and that again was real positive for the market. So look, bottom line for me, Westfarmers is pretty close to fully priced, so I'm not a buyer. I'm really waiting to see, now they've got rid of a lot of businesses, what the next big acquisition or investment is. We haven't had any news on that, and I think you've just got to be a little bit careful with Westfarmers. Great on Bunnings, can it continue? But what's the next move for Westfarmers?
It's interesting that both Bunnings and Officeworks have done well, and they really have been pushing those businesses in the media. Let's go to other reports, Paul, other companies.
Yeah, I think the general tone has been just a touch negative in the third week, Peter. I mean, there are a couple of themes, and you can see on the screen in front of you some positive and negative reports.
Yes.
The China story's been really interesting. A2 Milk has done really well. Blackwell's hasn't, so... And we've seen China...
Babies are more important than older people looking for good health.
Again, it's really hard to take out a trend. Webjet did well, but Flight Centre didn't. So, look, there have been some good surprises, some not too bad negatives. Overall, the surprises haven't been massive and the negatives haven't been too bad. But I think the negatives probably outweigh the surprises, more so in that some of the outlook statements are just a little more cautionary than the market would have expected. But the market's actually rallied through earnings season. I think that the other theme that's coming out of earnings season, Peter, is a lot of companies, they're giving a lot of cash back, lots of special dividends, off-market buybacks.
And people have to spend it.
People have to spend it. They're getting in ahead of any proposed change under a change in government. As we foresaw, we've talked about it many times, that money's got to come back into the market. And with interest rates now looking like they're staying low, and one economist suggesting that interest rates are going to go down in Australia, I think we're finding that sort of supply of money argument coming back and supporting share prices. So while it hasn't knocked your socks out, it hasn't been a disaster, but the market's actually found support and gone high during earnings season.
Great analysis.